If you're a veteran shopping for a home loan, you already know the VA loan is one of the strongest financing tools available to you. What most veterans don't know is that the loan itself isn't what determines how much you pay. The lender does. Two veterans, same credit score, same debt to income ratio, same loan amount, same city, same month, completely different closing costs. And we're not talking about small differences either. This video is about what that gap actually looks like, why it exists, and what you can do about it before you sign anything. The VA sets the rules for what lenders can and cannot charge you. That's real and it matters. The VA loan has some of the strictest fee protections of any mortgage product available, but within those rules, lenders have significant room to set their own pricing. Every lender that originates VA loans adds its own requirements on top of VA guidelines. These are called overlays, so internal policies that vary from lender to lender and directly affect what you pay and whether you qualify. Most veterans assume that because the VA loan is a government-backed program, the pricing and qualification standards are standardized. They are absolutely not. The VA guarantees the loan, the lender prices it and underwrites it. Those are two very different things, and understanding that distinction is the first step to protecting yourself. A 2025 white paper published by Vetted VA and Polygon Research analyzed over 124 million loan-level transactions using federal mortgage disclosure data to examine how VA loans are actually priced across the country. The national findings confirm what most VA knowledgeable loan officers already know: VA loans consistently deliver lower interest rate, lower denial rates, and lower overall costs compared to conventional and FHA loans on average. But the finding that was in the lender's variability analysis. Researchers isolated a single metro area and controlled for credit score, debt to income ratio, loan amount, and loan to value ratio. Same veteran profile, same market, same time period. The range in closing costs between the most expensive and least expensive lenders was dramatic, and it held up no matter how tightly they controlled the variables. The state they chose for this analysis was specifically selected because it had among the lowest average VA loan cost in the country. That means what they found represented a best case scenario. In markets with higher average closing costs, the spread between lenders is likely wider. Understanding why lender pricing varies this much helps you ask better questions when you're shopping. There are a few main drivers. Lender overlays, so VA guidelines set a floor, but lenders build on top of that floor based on their own risk tolerance, their secondary market strategy, and how they've structured their loan officer compensation. So two lenders following the same VA guidelines can price the same loan very differently. Origination charges. The VA allows lenders to charge an origination fee. How much they charge and whether they offset it with lender credits varies significantly. Some lenders charge more upfront and offer a lower rate. Others do the opposite. Neither approach is inherently better, but you need to be comparing the full picture, not just the rate. Discount points. Points are prepaid interest. You pay more at closing in exchange for a lower rate over the life of the loan. So whether buying points makes sense depends entirely on how long you plan to stay in the home. Some lenders build points into their standard offerings without clearly explaining what you're paying for. Lender credits. Lender credits work in the opposite direction. The lender absorbs some of your closing costs in exchange for a higher rate over the life of the loan. This can make sense in certain situations and be a bad deal in others. The key is knowing when you're being offered them and why. None of these tools are inherently good or bad. The problem is when veterans don't know how to look for them and end up comparing one lender's rate to another lender's total cost package without realizing they're not comparing the same thing. Pricing isn't the only place where lender overlays create real consequences for veterans. Overlays also affect qualification, and this is where a lot of veterans get turned away unnecessarily. The VA does not set a minimum credit score requirement. Individual lenders do. So a veteran with a credit score that falls below one lender's overlay minimum might be told they don't qualify for a VA loan and walk away believing that that's the VA's position. It is not. A different lender with a lower overlay threshold or no credit score overlay at all may approve that same veteran without issue. The same dynamic applies to debt to income ratios. The VA uses a residual income model, which is a calculation that looks at what's left over after all the monthly obligations are paid, and adjusts for family size and geography. That's their primary measure of a borrower's ability to repay. That residual income calculation can compensate for a higher debt to income ratio and result in an approval that a lender focused primarily on debt to income ratios might have denied. Here's why that matters for lender shopping. A lender that doesn't fully understand residual income or that applies conventional underwriting instincts to a VA loan may turn away veterans who are genuinely qualified. Residual income is a VA-specific tool that exists specifically to give veterans more flexibility than conventional underwriting allows. A lender who isn't using it correctly isn't fully utilizing the benefit on your behalf. So when you're shopping lenders, asking how they handle residual income and whether they have credit score overlays tells you a lot about how well they actually know the product. There's a persistent misconception that the VA loan is primarily used by borrowers with weak financial profiles, that it's a last resort for veterans who can't qualify for anything else. The data says the complete opposite. The same white paper found that veteran homeowners who used VA loans to purchase their homes have significantly higher net worth than veteran renters, and by a wide margin. And the VA loans approval and origination rates outperform every other major loan type, including conventional. Among minority veterans specifically, the data is even more striking. Minority households headed by a veteran own their homes at substantially higher rates than minority households without a veteran, a gap that VA loan access plays a direct role in creating. The VA loan isn't a fallback. For the veterans who use it well, with a lender who knows it well, it's the strongest financing tool, are often the ones who worked with a lender who treated a VA loan like a conventional loan with different paperwork. That's not a VA problem, that's a lender selection problem. The most common mistake veterans make when comparing lenders is looking at the interest rate in isolation. The rate matters, of course, but the rate alone doesn't tell you what you're actually paying. What you need to compare across all lenders is the loan estimate, a standardized document every lender is required to provide within 3 business days of receiving your application. The loan estimate shows your interest rate, your estimated monthly payment, all origination charges, all third-party closing costs, any discount points being charged, any lender credits being applied, and your estimated cash to close. When you have a loan estimate from multiple lenders for the same loan amount and loan type, you're comparing apples to apples. Without it, you're just guessing, assuming the lender your real estate agent recommends or the lender your bank already has a relationship with is automatically the right choice for a VA loan. VA loan expertise varies significantly between lenders. A lender that does a high volume in conventional or FHA loans may not have the same depth of VA knowledge and affects not just pricing, but how smoothly your transaction moves from contract to close. In fact, the average loan officer across America closes less than 1 VA mortgage per year. So who you work with matters. The CFPB recommends getting quotes from multiple lenders before committing to one, and the VA loan has a specific feature that makes this easier than most veterans realize. When multiple lenders pull your credit within a short window, generally around 45 days, the credit bureaus treat those pulls as a single inquiry for scoring purposes. So shopping multiple lenders does not hurt your credit score in the way some veterans fear it will. Here's a practical framework. Talk to at least 3 lenders before making a decision. Request a full loan estimate from each one, not just a rate quote. Compare the line items across each estimate, so origination charges, points, lender credits, and cash to close. Ask each lender what their VA loan volume looks like. How many VA loans they close per month is a direct indicator of expertise. Ask about credit score overlays. So does this lender have minimum credit score requirements beyond what the VA guidelines require? Ask how they handle residual income. So a lender who uses it correctly gives you more room to qualify. Ask how VA appraisals are handled, specifically whether they have experience with the Tidewater process and reconsideration of value if an appraisal comes in low. So the goal isn't to find the lowest rate. The goal is to find the best total package from a lender who knows the VA loan well enough to close your transaction without any surprises and who is working the full benefit on your behalf. One piece of this that works in your favor as a VA buyer and that many veterans don't fully use is seller concessions. VA guidelines allow sellers to contribute up to 4% of the established value of the property towards veterans' closing costs. That 4% does not include discount points or closing costs. Those can be covered separately through negotiation. So if a seller concession covers all closing costs and there's money left over, that excess can actually be applied towards the veteran's existing debts at closing. So a well-negotiated VA purchase can result in significantly less cash out of pocket, but only if your loan officer knows how to structure the offer and your real estate agent knows how to negotiate it. One more thing worth knowing, the VA allows any interested party, seller, lender, or other, to contribute towards discount points on your behalf. That's not a feature available on most loan types. If you want to understand exactly how these pieces interact with your specific situation, your purchase price, your market, your seller's position. That's a conversation worth having with a lender who knows the product. The link below is how you reach my team. If you already have a VA loan and interest rates drop, the VA Interest Rate Reduction Refinance Loan, known as the EARL, is one of the most streamlined refinance options of any loan program. So in most cases, it requires no appraisal and no proof of employment. There's typically no minimum credit requirement and no debt to income ratio verification in most situations. You can change your loan term, and in all cases, you can defer at least payment during the refinance process. Is the same as with the purchase loan. Lender pricing on EARLs vary just as much. So veterans who refinance through the first lender they called have, in some cases, left significant money on the table compared to what a competitive lender would have offered. The same shopping framework applies, so get multiple loan estimates, compare the full cost picture, and work with someone who does VA volume regularly. The VA loan is one of the most powerful financial tools available to anyone in the mortgage market. Whether it delivers on that promise depends heavily on who you work with. The data is clear that the range between the best and the worst VA lenders, even in the same market with the same borrower profile, is wide enough to matter significantly. Shopping that difference is one of the highest leverage financial decisions a veteran can make. If you want to know what the numbers look like for your specific situation, your credit, your market, your timeline, my team is happy to be one of the lenders you talk to. Use the link below to schedule a call. And if this is the kind of content that helps you get more out of your VA benefit, please subscribe. This is what we're here to do. I'll make sure that you win with Wade, and I'll see you next time.